With mortgage rates still near recent highs and the election now behind us, big shifts are on the horizon for the financial landscape, and there's more to come in 2025. So, what will these changes mean for mortgage rates? Well, today we'll dive into how the election, recent economic data, and the Federal Reserve decisions could shape mortgage rates moving forward. Now, whether you're considering to buy or refinance or just staying informed, let's break down the factors that could impact your mortgage journey through the end of the next year. So let's start with some context. A few days before the most recent Fed rate cut, the 10-year Treasury yield began creeping up, which continued after the election. Now, before election night, mortgage rates were holding steady, waiting for the outcome. But as the odds of a Trump victory increased, the 10-year Treasury surged above 4.3%, landing around 4.4% in mid-November. Now, although Treasury yields and mortgage rates aren't perfectly linked, they often move together, and a higher bond price doesn't really help the hopes for lower mortgage rates. Now, we've seen this wait and see approach and pattern before during elections, like in 2000 or 2020, where the prolonged vote counts kept rates steady. In 2000, mortgage rates stayed around 7.7% until the election was settled, and in 2020, they held in a tight range for months due to post-election uncertainty. In October, mortgage rates actually rose despite a Fed rate cut, driven by strong economic data, higher than expected inflation, and job growth. By the end of October, the average mortgage rate hit 6.75%, up from 6.16% in late September. As of late October, organizations like Fannie Mae, the Mortgage Brokers Association, and the National Association of Realtors predict that mortgage rates may trend down gradually, targeting around 6% to 6.3% by year's end, with potential dips below 6% in 2025. However, these projections depend on inflation, job stability, and the political and economic factors tied into the election outcome. Now, Freddie Mac analysts share a cautiously optimistic view, but note that rates could stay volatile if inflation persists or the economy remains strong. Global factors like oil prices and global economic shifts also add to that uncertainty. So now with Trump back in office, how might his policies impact mortgage rates and housing? Now, his administration has hinted at policies that could lead to higher Treasury yields, which often push mortgage rates higher. Some economists believe that rates could reach as high as 8% if inflation pressures rise under his fiscal strategies. For buyers, this could mean even higher monthly payments and even greater challenges with affordability, particularly for those first-time homebuyers. It does need to be mentioned that Trump has explicitly stated that he would like rates to be lowered, and this would include mortgage rates. Now, beyond interest rates, rising rates could also impact housing stocks. Major players like Lennar and D.R. Horton saw stocks drop after the election, reflecting investor concerns over housing demand if rates remain high. Trump pledged during his campaign to reduce mortgage rates all the way down to 2%, though that's an ambitious number and largely outside presidential control, as the Federal Reserve sets interest rates independently. Now, Trump has, however, suggested that presidents should have more influence over those Fed decisions. Now, let's also concern what a potential recession might mean for mortgage rates. Historically, when the economy enters a recession, the Federal Reserve often cuts rates at a very fast pace to stimulate growth, which can lead to lower mortgage rates. For instance, during the 2008 financial crisis and in the early months of 2020 pandemic, we saw the Fed cut rates sharply and mortgage rates dropped very fast as a result. If economic conditions were to decline into a recession, we could see the Fed take a similar action to support the economy, potentially leading to a relief in home buyers and refinancers with lower rates. Now, that said, some analysts caution that any rate drop would depend on specifics of the economic downturn. If inflation remains a concern, the Fed might have less flexibility to reduce these rates in a significant way. So while the recession could open the door to lower borrowing costs, inflation and market dynamics will obviously play a significant role in determining the extent to any rate relief. So to sum it all up, the 2024 election outcome and the economic indicators set the stage for a potentially mixed mortgage rate landscape in 2025 and going forward. Trump has promised to bring down mortgage rates, pledging as low as 2%, though some reductions would largely depend on factors outside of the presidential control, like the Federal Reserve policies and broader market forces. Still, it's worth noting that some analysts see a potential for rates to decline if inflation moderates and the Fed maintains its stance on rate cuts. Economists for Fannie Mae and the Mortgage Brokers Association predict that rates could trend down towards 6% by the end of the year and might even dip below that mark through 2025. This outlook suggests that while current rates and the market remain challenging, rate relief could be on the horizon if inflation and the labor market stabilize. Whether Trump's economic policies will ultimately bring rates down remains uncertain, but there is hope that a combination of Fed rate cuts, moderating inflation, and stable job growth could work in favor of lower mortgage costs. Now, if you're considering a refinance or a new purchase, I'll make sure to keep you informed on where rates go from here. Leave a comment below and subscribe to my weekly rate updates or newsletter, and reach out anytime with questions on how to make the most of these market opportunities.